Complete Guide to Crude Oil Trading. Crude oil is one of the most actively traded commodities in the world. A raw material that is commonly extracted from Middle Eastern countries, it is referred to as black gold and the mother of all commodities. Crude oil is used for manufacturing everything from plastics to petroleum, cosmetics to cars, and fabrics to pharmaceuticals. Trading within the oil markets can be a risky move, given the increased volatility throughout recent years. Where supply and demand are constantly changing, so is the price of oil. However, crude oil is a liquid commodity, meaning that it can be traded in large volumes and boasts a relatively tight spread of around 3.0 points on average. Read on to discover how to trade oil. Types of crude oil. The type of crude oil depends on the geographic location of the oil field and the characteristics of the oil itself. While there are hundreds of types of crude oil traded on the global market, two primary types of crude oil serve as global benchmarks for oil prices: Brent and West Texas Intermediate. 1. Brent crude oil. Brent oil comes from 15 different oil fields in the North Sea. It is also characterized as a light and sweet oil, although it is not as sweet or light as WTI. Up to 2/3 of global oil contract trades are on Brent. 2. WTI crude oil. As the name suggests, WTI is sourced from U.S. oil fields primarily in Texas, Louisiana, and North Dakota. It is referred to as light sweet crude oil due to its low density and low sulfur content. These characteristics make it less expensive to produce and easier to refine than heavy or sour oils. WTI is the main benchmark for oil consumed in the U.S. Why is crude oil a valuable commodity? Crude oil in particular is considered an extremely valuable resource within the commodities market, as it can be refined into everyday products, such as gasoline, diesel, and other petrochemicals, which are consistently in high demand. It is currently the world's primary energy source. In a modern world, there is an increasing human population and consumption of agricultural and recreational goods. This results in a greater need for energy, and therefore supply and demand is under pressure. Oil trading prices. Oil prices are highly volatile and heavily influenced by supply, demand, and market sentiment. There are a number of factors that affect oil trading prices in the UK, including the following. 1. Natural disasters, war, civil unrest. 2. Seasonal demand. 3. Population growth. 4. Global economic growth. 5. Shipping availability and freight rates. 6. Alternative fuel developments, including a demand for renewable energy. Oil trading can be a volatile process, so why not practice first on our demo trading account? How to trade oil. Crude oil can be traded through products that are suited for both long-term and short-term investment, by either buying and selling the underlying asset or using a trading platform to speculate on price movements. Here are the key ways in which you can trade on the oil market. Crude oil spread betting. Spread betting is our most popular derivative product that allows traders to trade on oil price movements for a wide selection of commodities, including both crude oil Brent and West Texas. Spread betting is a leveraged product, meaning that only a percentage of the full trade value is needed as a deposit to open a position. As a trader, you will not own the underlying asset but instead have the ability to speculate on price movements. Crude oil spread betting can be a risky process as the commodities market is particularly volatile, especially during times of economic crisis or instability. You can trade using our spread betting demo account with virtual funds before opening a live account. Spread betting is an attractive product in the UK, as it allows investors to trade tax-free on thousands of instruments, including both types of Brent and WTI crude oil. Oil CFDs. Contracts for difference, CFDs, are a type of financial derivative that work in a similar way to spread betting and allow to open a position on crude oil based on whether you think the commodity's price will rise or fall. However, the main difference between CFDs and spread betting lies in tax treatment. Please note that tax treatment depends on individual circumstances and can change or may differ in a jurisdiction other than the UK. How to trade crude oil futures. Perhaps the most popular method of crude oil trading is through futures contracts, also known as forwards. Oil futures are an agreement to buy or sell an exact amount of oil for a set price at a set date in the future. This type of contract trading is commonly seen within the commodities market due to the volatility of oil pricing. Rather than purchasing oil at its spot price, storing and then waiting for its value to increase within the market to then be sold again, futures prices predict how much the oil will be worth when it expires on the set date. It is an easier way to take advantage of price fluctuations without physically owning the underlying asset. However, trading oil futures can be a risky process as futures prices will also fluctuate depending on the price of oil, which is impacted by many external factors. Read more about futures trading.
Friends, thanks for watching. Please subscribe my channel for more videos.